A stop loss order is a type of order placed with a broker to buy or sell a security once its price reaches a specific level or a specified level, helping to limit potential losses. It is a key tool for managing risk in both volatile and stable markets. So in this video, I want to talk about the role of stop loss orders in managing risk. The role of stop loss orders in managing risk. So how stop loss orders work? How stop loss orders work? For a sell stop loss, if you own a stock and want to protect against a decline in its price, you set a stop loss order below the current market price. If the stock drops to or below the specific stop price, the order becomes a market order, selling the stock at the best available price. So you could set this particular order, order with the desire that once the stock gets below or gets to that particular price, then automatically the system will sell your stock for you. And for a buy stop loss, if you are a short selling, or if you are involved in short seller, you want to short sell a stock, a stop loss order can be placed above the market price to limit potential losses in case the stock price rises. There's one strange thing about short selling. If you want to short sell a stocks, if the stock price drops, you make profit. But if the stock price climbs, you sustain losses. Can you imagine that kind of strange behavior? All right. So in that case, you set a stop loss order at a price higher than the price you bought, so that should in case the stocks climbs up, then the system will sell off your stock, so that you not end up you not sustain further losses, because the higher the price goes, the higher your losses. So you set a stop loss so that you not incur more losses. So we talk about types of stop loss order. Types of stop loss orders. There's a standard stop loss order and there's a trailing stop loss order. So in the case of a standard stop loss order, it's a basic order that triggers a sell or a buy for short positions when the securities price hits the stop price. Then for trailing stop loss order, the stop price moves with the market price, maintaining a fixed distance below the market price for a long position or above for a short position. This allows you to lock in profits while still protecting against downside risk. So this trailing order, once you fix it, you place this order above your buy price. So when the stock is going up, it maintains that particular tempo. All right. And if in case the stock drops, then the position is sold out to avoid losses. Let's look at stop limit order. Stop limit order. A variation of the stop loss where after the stop price and the stock price is reached, a limit order is placed. This ensures the order is only executed at a specified price or better. But there is a risk that the order may not be filled if the price moves too quickly. So if the price moves too quickly, unfortunately, that order may not be executed. Let's look at the benefits of using stop loss orders. The benefit of using stop loss orders. The key benefit here is risk management. Stop loss orders help prevent catastrophic losses by automatically closing a position when the market moves against you. As a trader or as an investor, and the market is moving against you, you are incurring losses. You set a stop loss order so that you may not incur further losses. Once that particular price is reached, then of course the system will sell off your position and you will not sustain further losses. You talk about automation. It removes the need to constantly monitor the market, which is especially useful for a busy investor or for those who can't watch the market throughout the day. So you simply buy your stocks, set a stop loss order, and then your stock will be sold out at that price to avoid losses. Then, not only that, it has to also do with emotion-free trading. Another benefit is emotion-free trading. We've discussed automation, we've discussed risk management. We also want to discuss emotion-free trading. It helps investors stick to their trading plans without being swayed by emotions like fear or greed, avoiding the temptation to hold on to a losing position. Sometimes out of probably love for the stock, you may be tempted to hold on to a losing position. But if you put in this particular order in place, once the stock gets to a position you consider you are losing, it will then sell off your position, sell off your stocks without incurring further losses. Let's also look at profit protection. It serves as an avenue of profit protection. In a rising market, trailing stop losses lock in profit by allowing you to stay in the position while protecting yourself from a significant drop in price. So you are protected. In a case where there's a drop in price, you could exit the market even at a profit. So it helps you to lock in profit, to protect your profits so you will not end up with a loss. Let's consider the limitation of stop loss orders, the limitations of stop loss orders. In this case, we want to look at market volatility. In a fast-moving or volatile markets, price can temporarily dip below the stop price, triggering a sell at an unfavorable price, leading to slippage. There's no guarantee that you will always sell off your position at the stop loss. Please don't forget to like this video and subscribe to this channel. Sometimes when the market is so volatile, the price can even go below your stop loss. All right. And that is not something that is palatable at all, And number two, there's no guarantee of price. There's no guarantee of price. So for standard stop loss orders, the execution price could differ from the stop price, especially in an illiquid market or during significant price swing. So there's no guarantee that you could sell out a position. You could execute your sales at that particular price. No, it may not really happen. In a case where there's illiquidity, or if there's some other market condition could guarantee that you may not really exit the market at that price. So there's overuse or misuse. That's another limitation. They could be overused and they could be misused. Setting stop loss orders too tight, that's close to the current price, can result in premature sales, during normal price fluctuation, potentially causing you to exit a position too early. If it is too low, let's say you bought a stock at $5 and you're setting a stop loss as $4.50. You discover that it's just too low. So a normal fluctuation could even sell off your stocks. Just normal price, movement can sell off your stocks. So you have to avoid that. Not only that, it may not protect at all at after hours trading. At after hours trading, there's no guarantee of protection because most stop loss orders are only effective during normal market hours. After hours or pre-market price gaps could mean your stop loss orders is triggered at a much worse price. Let's look at best practices for using stop loss orders. Best practices for using stop loss orders. In this case, we consider, you set reasonable stop prices. You need to set a reasonable, achievable, attainable, stop loss and stop prices. Avoid setting stop losses too close to your purchase price. A typical strategy is to place them a few percentage points below your entry price depending on the stock's volatility. So you use trailing stop loss for long-term position. You use trailing stop loss for long-term position. A trading stop loss, a trading stop rather, can help lock in a profit at prices as prices rise while still offering protection against sudden decline. So this trailing stop actually trails the stock movement. As the stock is moving up, it trails the rising price along the way. So you also combined with other risk management strategies. You don't just adopt this strategy alone. You also inculcate other risk management strategies alongside your existing strategy. So stop loss orders should be part of a broader risk management plan, including diversification as well as position sizing. For example, let's take a typical example here. You purchase 100 shares of stocks at maybe let's say $50 each, and wants to limit your loss to 10%. So you place a stop loss order at $45. So if the stock drops to $45 or below, your shares will automatically be sold off, limiting your loss to only $5 per share. So that's how it works. You buy a stock at a particular price, and you don't want your losses to exceed a particular percentage, let's say 5%. So you set your stop loss at 5% below your buy price, so that your losses will not exceed 5%. Let's assume all things being equal.